Hello and welcome back to Dukascopy TV. Europe is always cropping up in our reports as it is a region that has such an effect on the markets when something happens. With the next monetary policy statement and rate decision expected on Thursday, I'm talking to Professor of Economics and Technology at the Business School INSEAD, Robert Ayres, in a two-part interview about unemployment in the region and also its importance globally. Professor Ayres, thanks for joining me today. Just how important is unemployment and the role it plays in realizing economic growth today?
Well, I would say that unemployment is primarily a consequence of lack of growth, and I don't think it's really possible to underestimate the importance of unemployment for the future, which includes growth. But I don't see any direct connection between unemployment and growth itself. It's a consequence more than a cause.
Now, we've seen governments globally, not just in Europe, struggle with creating more jobs. How much can it cost an economy to create those jobs?
The basic problem for governments is that they've allowed the central banks to take the primary role, and the central banks only have one really useful tool, and that's to make interest rates low. And we all know that keeping them low for too long leads to bubbles, bad investments, and lays the groundwork for future problems. Where the effort needs to go, I think, is very directly towards providing better access to borrowing, that is lending to, borrowing by the small and medium firms. The big firms not only do not provide many new jobs, but they also don't need the banks. They usually get their capital by selling bonds or by IPOs. What the banks need to do is to lend more to the small and medium firms, but they won't do it as a consequence of being, nobody can give them an order to do that, and they are discouraged from doing it by the rules created by the Bank of International Settlements, BIS, that is the so-called Basel rules, which control the way in which, it's the risk weighting of the various assets they use. So the higher risk of their loans, the less they can lend. This is really the problem.
Looking at the very nature of employment in business, a lot of companies are being bought up by wealthy hedge funds and are being, as you described to me before the interview, re-engineered. This used to be a speciality of the ex-US presidential candidate Mitt Romney. Does this create or destroy jobs, do you think?
That's a very, very pertinent question. I think the fairly obvious answer is that in the short run, this kind of activity tends to destroy jobs, simply because if you can lay off some people who are near retirement or who are regarded by the let's say the buyer as not necessary for current operations, if you can cut the benefits in some way, if you can claim that the pension fund is already overfunded, which used to happen quite a lot. There are lots of ways in which these re-engineering people try to make the bottom line look better, but none of them require adding employment, and all of them, or many of them, involves laying some people off. So I think in the near term, this activity, the so-called private equity activity, and most of the hedge funds really do not create jobs. Some of them may have successes in making a company stronger, and in the long run there may be some new jobs created. But I think in the history since 1982, when this whole thing really began, if you look at what has happened since then as compared to before that, In the United States, the rate of increase of GDP has slowed down since then as compared to previously. Unemployment has actually tended to grow on average. And so I don't think, and yet the share of the economy held by the financial sector has increased quite a lot, as has the remuneration of the CEOs and the managers. So the economy has become much less equitable. Only the top 20% of the employees have done better in the last 30 years. Only the top 20%, and the top 1% have done extremely well. But the bottom 20% have lost, and most of the population, most of the working population is no better off than they were back in the 80s. It's a very sad story.
Do you think that the ever-growing gap between those employers who provide their staff with extremely high incomes and bonuses and those who don't are having a detrimental effect on employment in Europe?
Well, it's not easy to see a direct connection, except, well, there are a couple of things. One is that, for example, in a business school where I used to work, by far most of the MBAs were trying to get jobs in finance or in the high-profile consulting sector. Hardly anybody was really looking for jobs in manufacturing or in other services. And so if the best brains are going into finance, that's one factor, which I think is detrimental to overall economic growth. More perhaps to the point, simply the inequality is not helpful to growth because if you think in terms of the tools that the central bank has to use, namely the interest rates, the spending by lower income people goes much more directly into goods and services for the general public, whereas the spending, the large incomes, the high degrees, the bonuses and so on of the people at the very top, doesn't really get spent on goods and services in the general economy, and therefore doesn't increase employment there. And what they do with their money, by and large, is to invest it in hedge funds and buy more companies and buy super yachts, maybe. But it's that sort of thing. And generally speaking, more spending in the lower income sectors is more beneficial than more spending by the very rich.
Okay, thank you for joining me today. That's the end of part 1 on this subject. We'll return with part 2 for you next week. But for now, goodbye.